First of all, let me define what listed infrastructure is. We invest in equities which own and or operate infrastructure assets across four main sectors: telecommunication, energy, utilities, and transportation. These are core infrastructure assets which play a critical role in any economy or in any society in which they operate. Investing in infrastructure brings many benefits. First and foremost, predictability and resiliency of cash flows, higher level of income, preservation of capital in real terms during inflationary environment, liquidity, and exposure to long-term secular tailwinds. And because of these benefits, investors allocate to infrastructure equities either as a liquid alternative to direct infrastructure or a defensive building block in a diversified equity portfolio. We believe that we are at the beginning of a multi-decade investment cycle in infrastructure, supported by long-term secular tailwind such as digitalization, electrification, and urbanization. Starting with digitalization, we are experiencing an exponential growth in data traffic as a result of the significant increase of connected devices worldwide. And telecommunication networks were never built to handle so much data that needs to travel at so much speed. And because of this, we are seeing a significant amount of investment going into telecommunication network infrastructure to be upgraded and to be expanded in order to accommodate the growth in data traffic. From an electrification standpoint of view, we're also seeing an increase in electricity demand, both in developing economies as a result of demographics and urbanization, but also in developed economies as a result of the onshoring of manufacturing processes and also the AI-driven related demand growth in data center. And this is requiring billions and billions of dollars to go and be invested across the energy and electricity transmission and distribution value chain, also to accommodate the evolving energy mix towards cleaner source of supply. And finally, on urbanization, we are seeing millions and millions of people moving from rural areas to urban areas. And in order to support this rising urban population, governments need to invest to provide them access to basic service, whether it's electricity and heating, whether it's water and sanitation, whether it is connectivity, mobility, allowing at the end of the day a rising standard of living. Investing in infrastructure equities requires a lot of time and a lot of dedication. Analyzing the asset, assessing contracts and regulation, engaging with multiple stakeholders across various industries, value chains. And we believe that these analyses can be undertaken in a more efficient and effective way by dedicated investors who, thanks to this ongoing research, can also capture the price-value dislocation that arise in our asset class from time to time. As we invest in equities, opportunities are not just the result of the long-term fundamentals of the asset class, but are also the result of equity market volatility or market sentiment that can create dislocation between price and value. And today there are two main areas where we find opportunities. The first one is in Europe and UK, where we see the biggest dislocation between price and value in sectors such as water utilities, telecommunication, or energy, also considering that our estimates of value is quite conservative and below where private transactions have taken place in the sectors in the past. The second area is in North America, where the AI-driven related growth in data center, onshoring of manufacturing processes is creating the need for more electricity. And of course, in order for electricity demand to be met, investment need to go across the entire energy and utilities value chain. And so we are seeing a step up in growth rate on many companies in which we invest, which of course represent an opportunity for us. Our investment process is based on two pillars. It's based on quality and value. which means that as we undertake our asset-driven fundamental due diligence, we assign a quality and evaluation score to all companies in our investable universe, and quality and valuation scores then become the key driver on whether these companies are going to be included or not in our clients' portfolio. We also complement our bottom-up quality and value-driven approach by a top-down risk management overlay in order to ensure that there is appropriate diversification across sectors and across regions, and this to avoid our clients' portfolio to be significantly impacted by any single macroeconomic drivers, whether it's inflation, interest rates, energy prices, or GDP. A clear example is what is happening in the US with electricity demand. Electricity demand for the last 10 years was flat. Now it is expected to grow between 2 and 3% for the next 10 years. Of course, this requires billions and billions of dollars to be invested across the energy and utilities value chain. The biggest impact of the current geopolitical events on infrastructure is around deglobalization, as developed economies are onshoring manufacturing processes. And of course, this creates a lot of challenges, as developed economies now need to invest in an aging infrastructure or replacing aging infrastructure to accommodate the increase in manufacturing capabilities. Listed infrastructure are trading at the bottom end of historical valuation ranges on traditional multiples such as enterprise value to EBITDA, price to earnings, or dividend yield. And the lower level of valuation, coupled with the lower correlation to global equities, can provide investors a good opportunity to diversify away their equity exposure, particularly if they're looking for a more defensive asset allocation.